became Southeast Asia's fastest growing economy.
The country's economic growth outlook to become the second fastest growing economy.
When people talk about the most dynamic economies in East Asia and the Pacific, one country consistently earns a spot in that conversation: the Philippines. What makes it stand out? It's the only emerging economy in Southeast Asia that didn't build its foundation on oil and gas. Look around the region. For decades, many of the Philippines' neighbors powered their rapid rise through energy wealth. Indonesia, the region's top crude producer, even though output has been challenged by aging fields. In 2025, national oil lifting was averaging around 570,000 to 580,000 barrels per day, and the government is aiming to boost that toward higher levels by the end of the decade. Malaysia also continues to produce substantial volumes, with crude oil and condensate output holding firm at roughly 500,000 barrels per day in recent reporting, supported by ongoing upstream projects. In Thailand, oil production has hovered near 415,000 to 420,000 barrels per day, making it one of the more significant producers in the region, despite overall energy imports outpacing local supply. Vietnam's oil output is smaller, but still meaningful. While exact daily figures fluctuate with field performance and reporting, its crude and petroleum production remains an important part of the country's energy sector, even as output levels are lower compared with Malaysia and Indonesia. In these countries, oil wasn't just another industry, it was the launch pad. Energy revenues helped lower power costs, fuel industrial expansion, and finance the shift from commodity-based economies to manufacturing and service-driven powerhouses, including booming tourism sectors. Vietnam's surge, for example, has been supercharged by exports and a strong manufacturing base, supported in part by the advantages of domestic energy production. Now here's where the Philippines takes a very different path. As of 2026, the Philippines' oil and gas sector remains a very small piece of the overall economy, contributing less than 1% to the country's GDP. Daily crude production is minimal, only around 9,000 to 10,000 barrels per day, a tiny output compared to other energy-producing nations in the region. Meanwhile, national demand tells a completely different story. The country consumes roughly 500,000 barrels of oil every single day. The gap is enormous. Because local production covers only a small fraction of total demand, the Philippines continues to rely heavily on imported oil to power its industries, fuel transportation, and keep the economy moving. Unlike export-driven economies such as Vietnam and Singapore, the Philippines has long faced trade deficits due to high imports of raw materials and intermediate goods. And while Thailand, Malaysia, and Indonesia consistently rank among the region's top tourism magnets, Philippine tourism is still expanding and finding its full potential. So, here's the bigger picture. The Philippines is growing, and growing fast, without the massive oil cushion that helped jumpstart many of its neighbors. No deep energy reserves, no oil-funded industrial leap, no petrochemical backbone powering early development. Instead, its momentum comes from a different mix: services, remittances, domestic consumption, and a young, expanding workforce. In a region where oil once fueled economic takeoff, the Philippines is writing a different story, one built not on barrels of crude, but on resilience, adaptability, and human capital. And that's what makes its trajectory so compelling. Now here's the surprising part. Even without massive oil revenues, even without an export machine like Vietnam, even without tourism numbers that rival Thailand or Malaysia, the Philippine economy is still thriving. In fact, it's widely recognized as one of the most dynamic economies in East Asia and the Pacific. So, what's the secret? How does a country without major oil wealth, without dominant export power, and without top-tier tourism numbers continue to compete and grow alongside its regional peers? The answer lies in transformation. The Philippines is considered a newly industrialized country, an economy that has steadily shifted away from agriculture and moved towards services and manufacturing. And that shift has changed everything. Today, the service sector is the undisputed engine of the Philippine economy. Back in 1980, services accounted for just 36% of GDP. Fast forward to 2025, and that number has surged to more than 61%. It didn't just grow, it overtook industry and left agriculture far behind. Even more telling, the sector now employs 58% of the country's workforce, more than agriculture and industry combined. That kind of expansion doesn't just change numbers on a chart, it reshapes skyline. As demand for office space skyrocketed, central business districts began rising across the country. What started as economic growth quickly turned into physical transformation. Cranes on the horizon, new towers climbing upward, entire districts built to support finance, IT, business process outsourcing, and corporate headquarters. And at the center of it all stands the country's most iconic business hub, the Makati Central Business District. Developed in the 1950s, Makati emerged as commercial activity gradually shifted away from Binondo, Manila's historic Spanish-era business district, into a more modern financial core. Today, Makati is one of the most vibrant business districts in the Asia-Pacific region. It hosts the regional headquarters of major local conglomerates and global corporations. Glass towers, financial institutions, multinational firms. It's the beating heart of Philippine commerce. The Philippines may not have built its rise on oil wells or massive export surpluses. Instead, it built it on services, urban growth, and the steady evolution of its economy. And that transformation is still unfolding. And the story doesn't stop in Makati. Another powerhouse business hub is Ortigas Center, strategically positioned at the crossroads of Pasig, Mandaluyong, and Quezon City in Metro Manila. Spanning more than 100 hectares, it stands as one of the capital region's most important financial districts after Makati. But Ortigas isn't just office towers. It's a vertical city packed with massive shopping malls, high-rise condos, BPO offices, major banks, government agencies, nightlife spots, restaurants, and corporate headquarters. Day and night, it moves. Suits in the morning, city lights after dark. Then there's Bonifacio Global City, or BGC, a district that feels like a glimpse of the future. Located in Taguig, BGC is one of the most modern and carefully master-planned urban developments, not just in the Philippines, but anywhere in the world. Wide avenues, sleek glass towers, walkable streets, global brands, international schools, luxury hotels. It's home to multinational outsourcing firms, major financial institutions, global corporations, and even the unified trading floor of the Philippine Stock Exchange. High-end malls and foreign embassies add to its global city atmosphere. BGC isn't just growing, it's setting a new standard. And along Manila Bay rises another bold development, Bay City. This area blends business and entertainment on a massive scale. It features Entertainment City, often compared to the bright lights of Las Vegas, alongside offshore gaming firms, BPO offices, corporate hubs, and the world-famous SM Mall of Asia, one of the largest malls on the planet. But here's where it gets even more interesting. This growth isn't confined to Metro Manila. Regional business districts have been rising across the country, from Cebu to Clark to Davao, supporting provincial operations of BPOs and global service firms. With strong government backing, improved infrastructure, and a young English-speaking workforce, the business process outsourcing industry has expanded year after year. The result? Explosive growth. Today, the BPO sector is the backbone of the Philippine service industry. It contributes roughly 30% of the entire service sector, or about 10% of the country's total GDP, and employs millions of Filipinos. With more than 1,000 BPO companies operating nationwide, the Philippines commands around 10% of the global outsourcing market. For years, it has ranked among the world's top outsourcing destinations, even rivaling, and in some segments, surpassing India. And when the pandemic hit, this sector proved its resilience. As companies worldwide shut down, Philippine BPOs pivoted almost overnight, shifting from office-based operations to work-from-home setups. That flexibility helped cushion the economy during one of the most challenging global downturns in modern history. But there's another powerful engine quietly fueling growth: service exports. The Philippines is one of the region's top exporters of services, outperforming many of its neighbors. This includes IT services, professional services, and the income generated by millions of Filipinos working abroad. These service exports alone account for about 10% of the country's economy. So while others built their growth on oil fields or factory floors, the Philippines built its momentum on something different: its people. From gleaming business districts to call centers operating 24/7, from global service contracts to overseas professionals sending money home, the Philippine economy isn't powered by barrels of oil, it's powered by human capital. And that may be its greatest advantage of all.
Now here's the real game changer. There are about 12 million Filipinos living or working abroad, nearly 11% of the country's total population. That makes the Philippines one of the largest diaspora nations in the world, with its people spread across more than 100 countries. Think about that. 1 out of every 10 Filipinos is overseas, building careers, raising families, gaining citizenship, and sending money back home. Of that number, more than 2.2 million are overseas Filipino workers, or OFWs. And their remittances do more than support relatives. They power the entire economy. That steady flow of money fuels domestic consumption. It increases household purchasing power. It keeps small businesses alive. It drives real estate, retail, transportation, food, education, almost every corner of economic activity. And it doesn't stop there. At the same time, the rise of the business process outsourcing industry has created another powerful stream of foreign income. Dollars flow into the country through service exports, call centers, IT services, finance, healthcare information management, and more. Together, remittances and the BPO sector have created a strong alternative growth engine, one not dependent on oil fields, massive tourist arrivals, or export-heavy manufacturing. The impact is massive. Domestic consumption accounts for roughly 70% of the Philippines' GDP, making it the single biggest driver of economic growth. And collectively, the BPO industry and service exports contribute around 20% of the entire economy. In countries like Indonesia, Malaysia, and Thailand, oil, gas, tourism, and manufacturing laid the foundation for rapid expansion. The Philippines took a different route. Instead of relying on natural resources, it invested in human resources. Instead of exporting oil, it exported talent. Instead of shipping barrels, it delivered skills. Instead of depending on factories alone, it built a global workforce. And that strategy worked. Even without the traditional economic advantages enjoyed by many of its neighbors, the Philippines has managed to compete and grow by turning its people into its greatest asset. At the end of the day, the true engine of the Philippine economy isn't found underground. It's found in its citizens, at home and across the globe. And that human advantage may be the country's most powerful resource of all.